Hello, hello. Welcome everyone to Raising the Bar. I see that you all made it into our classroom. It looks like my name is Laurel Starks. I am going to be your host today, and hopefully you all can hear me just fine. Please go ahead and introduce yourself in the chat. Make sure it says panelists and attendees so that we can all see you. As you all pour in, we will go ahead and give you a moment to introduce yourself. And just let us know where you're from as well. I hope you all can hear me. Hello, Frank. There we go. Deborah Crawford, Monterey. First one. Awesome. Great to see you guys. So as I indicated, my name is Laurel Starks, and I am a court-appointed divorce real estate expert here in the Inland Empire of Southern California. And welcome to all of the attorneys that are here just local to me as well. Good to see you all. I am also the founder and the CEO of the Ilumni Institute. We are the certification body for certified divorce real estate experts. We have got a very relevant and very good topic for you today. It is social insecurity and how to avoid Social Security pitfalls in divorce. Mr. Napolitano is also going to be going over the lifetime balance sheet, which is a pretty eye-opening thing. So I'm excited for that. So we are all excited that you are joining us. Before we begin, I do have a few announcements. Raising the Bar is a national virtual CLE program, and it is brought to you by the Alumni Institute. So at Ilumni, we believe that the real property aspect of every case deserves its very own expert, just like every other aspect of cases have their own expert specifically trained in family law. So real estate is often the most complex asset to deal with. It is the largest asset and the largest debt, riddled with emotions most of the time. It should not be left to a generalist, and that is why we have developed the most comprehensive curriculum and training program along with our attorney and judicial officer faculty that is in the industry. So the next time you have a real estate matter or a listing that needs to be sold or that you need a consultant with, the first call should be to your local CDRE. We are now in 25 states. So we've got family law attorneys and professionals who are joining us from 25 states today, which is very exciting. A couple of other things I do want to mention that we do get CLEs, in these 25 different states. So our CLE department at Ilumni works very, very hard and very diligently to ensure that all of these that all of you are given your certificates. I do want to shout out to those of you who are joining us from California. The California State Bar has been extremely backed up this past year, and so they are running several months behind. Rest assured, as soon as we get the certificates, they are forwarded to you. So it is not that you missed anything. It is not that we have not done our part. We are just simply in a waiting game for the California State Bar. So hang tight, and you're welcome to check in with us at any time. Hopefully you all have found your handouts. So your handouts were emailed to you. I am going to drop a link also in the chat here in just a second that will be to the handouts also. So for some reason you didn't get a chance to download your handouts, they are right there in your lesson in the Ilumni U portal. Speaking of Ilumni U, it is our virtual campus. So you will have access to replays of any of the other Raising the Bars that you've attended. You are welcome to replay them anytime. We can't give CLEs for that, but you're welcome to replay them. We are happy for you to share them with your office as well, because we feel that there's a lot of really good content that is also in there. So once we are over with, we are going to wrap up at 15 minutes past the hour, and you will need to return to your Ilumni U portal and fill out the evaluation form, and please upload it. So also mark your calendar for next month. We are here the fourth Wednesday of every month. And the fourth Wednesday of next month, we've got a very interesting and I'm excited to hear this topic. It is with certified family law specialist Carrie Pines and Dr. Robert Simon. They're going to be talking about interpreting the digital dialogue of emoji in domestic violence and custody matters. So mark your calendar for that. Registration for that will be open later on today or tomorrow, and you will know about that as well. So, all right. Well, I think that we are now ready to begin. Frank, are you ready?
I am. Laurel, can you hear me okay?
I can hear you just fine. So I will go ahead and
Excellent.
do a brief introduction. Frank Napolitano, he holds a Bachelor's of Arts degree from Harvard University. He obtained his Juris Doctor from BU. College of Law. He is committed to bringing an academically rigorous approach to his clients' issues. He is both a certified financial planner certificate and a chartered financial analyst charter holder. Frank is a member of the National Association for Divorce for Personal Financial Advisors and the National Association of Divorce Professionals. Side note, I heard Frank speak at an NADP conference in Fort Lauderdale a few years ago. And what he talked about as it pertains to the lifetime balance sheet and the financial impact of divorce that divorce has on a couple's and a family's finances over their lifetime was something that impacted me. I was just completely taken by his talk, and so I never forgot a lot of what he said. So when I reached out to and asked him if he would be so kind as to present for us, I was thrilled that he agreed to do so. So all right, Frank, I am going to turn it over to you. Oh, one other quick thing. Please, if you all have questions, I'm going to be curating your questions and ensuring that your questions do get answered. So please feel free to either drop your question in the chat, or you can also use the Q&A. There's a little Q&A thing down there at the bottom. You can use that as well. And I will be asking Frank the questions on your behalf. He will probably let you know he's gonna try to hold off most questions unless it's something that's very, very relevant. And when you do put your questions in the chat, make sure that it says panelists and attendees, because only attendees or only panelists are Frank and myself. So we want your question to be known to everyone. Okay, that's it. I'm done. Here you go, Frank.
Okay, excellent. Excellent. So, Laurel, I'm going to share my screen here, screen number 2, and if that worked properly, there's a video of myself here, social insecurity here at the top. So thank you all for joining and for taking time out of your day to hear a talk about Social Security. This is an important topic, and sort of near and dear to my heart, and I've written a lot about it, and there's a lot in the handouts there, I think, that is either you're going to find very useful or as a cure to insomnia, but be that as it may. Very briefly about myself, Laurel already introduced myself. I'm not going to review this a lot, except maybe to explain this little colorful bird here. So I'm a senior financial advisor at Sensible Financial. We're a fee-only financial planner. Offices here in San Diego and in Boston. Originally from the East Coast, so I did my undergraduate at Harvard University, then went to Boston University Law School with a focus in business and financial law, and transitioned right away into financial planning at a law school. So I got my CFP certificate early on, and a few years after that, my CFA. In terms of why I'm here talking about divorce, well, 4 years ago I went through a divorce of my own. I bought my first house for myself and my then wife, and within a month of moving into the house, found out that we were getting divorced. And that was, besides the personal elements of it, which are difficult, of course, the math, if you will, the hard numbers was quite a shock to me. And realized for all of the training I had in finance and in law, I was really unprepared for understanding how divorce would impact in my case, me in the long run here. So I got involved in it. I've written a bit about it. I'm a founding member of the San Diego chapter of the National Association of Divorce Professionals. I've spoken at their conference. That's how Laurel and I met. And finally, if you're wondering what this green bird is doing here, to humanize myself outside of our professions, we all have things that we do. One of the things that's also near and dear to my heart, besides this topic and my clients and this work, is I volunteer and a board member at this exotic bird sanctuary in Del Mar, California. So I saw a few of you are here in the Southern California area, a few from Arizona. If you find yourself close to San Diego, you can look us up. You will probably find Midori there, who's my favorite, and you may find me there as well, since I spent a good bit of time there. So the session goals here. There are 3 ideas I want to impart on you, and I will try to succeed. There's a lot of information here, and this is also going to be recorded. First, I want to impart some understanding on, first of all, what a lifetime balance sheet is and how it provides some really important insights into a household's lifetime finances. Okay. I'm going to illustrate the long-term impact that divorce has on a household's finances, and I'm going to use the lifetime balance sheet as the lens through which to view this this very impactful event on a household's life. I'll use a case study here using real numbers. And then I'm going to talk about Social Security, which just may surprise you, but for many Americans, this is their largest asset. And I like talking about Social Security and focusing on Social Security as one of the only assets, perhaps the only asset, that people can split really evenly here and not negatively impact the other party. Social Security is a fantastic social program that's out there, but it can also help people going through a divorce by providing a lifetime inflation-adjusted annuity. And I'm going to quantify that benefit there and give some recommendations that I have for professionals with clients going through divorce and even post-divorce leading up to their 60s when they would be applying for Social Security. But I'm going to begin with the lifetime balance sheet and introduce that and talk about how we can measure the impact of divorce on someone's living standard. Okay. So first of all, what is a lifetime balance sheet? Well, a lifetime balance sheet is an illustration of a household's full picture view of their finances. Everyone has a lifetime balance sheet. Okay. It illustrates lifetime assets here on the left and the lifetime spending of a household or an individual. And the lifetime balance sheet is itself composed of lifetime assets here on the left and lifetime spending, which we break into two components, and I get into that in just a second. Now, on the asset side of the lifetime balance sheet, we have, I'm going to use my pen tool here, non-retirement. I'm going to read this, the text is a little small, I apologize, but non-retirement savings and retirement savings. This is what I'm going to call current assets. These are the assets that, let's say myself dealing with clients sort of have insight into, and if they're thinking about a net worth statement, they're thinking about their checking, savings, investment accounts, retirement accounts, IRAs, 401ks. What they're not thinking about, much more frequently, is things like the future value of their earnings, which for a young couple can be a very sizable asset. To put in perspective, if a client is making $200,000 a year and they're 35 years old and they're planning on working for 30 years, well, that's $6 million, right? The largest asset on young professionals' balance, young people's lifetime balance sheets is usually lifetime earnings. We'd also include things like employer contributions if a client is getting a 401k match, or maybe they're working for a hospital and getting fee contributions. And then here at the bottom, we have Social Security. And this is a hypothetical couple here. This is a married couple, and their combined lifetime Social Security benefits, this is for two people now, is about $1.7 million, a very large asset indeed. Okay. Get my laser pen tool again. From lifetime assets, we subtract lifetime committed spending. So this column here. Lifetime committed spending, we call them committed because these are expenses that people are obligated to pay. So things like lifetime federal and state tax liabilities. Right? Housing expenses, this is important. So this includes not just if somebody is a homeowner, so the mortgage on the house, but all of the expenses associated with owning a home. And Laura was saying earlier that home is the largest asset, but also the largest liability. It's absolutely correct when you add together the future value of all property taxes, the future value of all major and minor maintenance, utilities. The housing expenses is often a large or sometimes the largest expense on people's life balance sheet. This category here of what we're calling special and insurance expenses is simply the insurance that people have over the course of their lives. So health insurance, life and disability insurance when clients are younger, through long-term care insurance, Medicare, through old age and retirement. And special insurances are simply a catch-all that we use for these large, lumpy expenses. That's the technical name for things like replacement automobiles. If it's a client with children and they're planning on funding college or portion of college, that's a special expense that goes in there. So this is the sum of lifetime committed spending. And the remainder, so lifetime assets minus lifetime committing, is what we're calling your living standard support. It is itself a type of account that households have, and that funds their living standard. Okay? And so the living standard is what's left over after fully funding all committed spending. Now, how is this lifetime balance sheet useful? Well, again, as I've said, it's lifetime assets minus lifetime committed spending. We can help people understand what's available for their living standards. Sometimes just seeing this visual picture lets people see, wow, I'm spending much more on my house, in our house, than we thought, and there's not enough here to spend time living our life, traveling, seeing friends, spending time with family. The lifetime balance sheet is also really useful in terms of scenario analysis. So we could visualize, for example, major life changes. And for example, if a client comes to us and they say, well, we're thinking about buying a larger house. Well, we could show them the impact of that home purchase decision and what that translates to in terms of the rest of their financial plan, or in this case, buying a larger house and keeping it for life might mean reducing some expenses, perhaps in the form of private school savings if they're moving to a better school district. But in this example, it's reducing what is available for them to spend on their living standard. That's an important decision. It's an expensive decision when you buy a house. So knowing what the long-term implications of that planned expenditure are going to be beforehand is very valuable. So the lifetime balance sheet can help people make better informed financial decisions and also help them prioritize their goals. In a similar vein, right? So this is the expense side of the equation here for a moment. In a similar vein, we could show a client what increasing resources does to their financial picture. So working longer or taking a higher paying job, well, that increases on the whole a household's living standard support. Okay, again, a very useful when we are getting together, either doing initial financial plan for a client or an update. There's an opportunity and say, well, take a higher paying, more stressful job, or I might consider working an additional 5 years. What does that translate in terms of our living standard? So the lifetime balance sheet, great for scenario analysis, great for distilling a lot of information into a single piece of information, a single graphic here. And how we use it in terms of advising clients, visualizing really the long-term impact of these decisions, helps them prioritize their goals and objectives, but also allows us to translate that lifetime balance sheet into a lifetime budget. So I want to talk just very briefly here about a concept in finance and in personal finance, which is your sustainable living standard. Your sustainable living standard is your highest living standard given your lifetime assets and lifetime committed spending. So here we have, again, in the upper right-hand corner, that lifetime balance sheet, lifetime assets, lifetime committed spending, and what's left over. And that living standard support, that notional account can be translated into a smooth living standard. This is households or an individual sustainable living standard. The concept is rooted in economics, what's called the life cycle hypothesis, but the idea is quite simple. The idea is simply people, rational actors, choose to smooth or equalize their living standard over the course of a lifetime. And this is, for us, the basis of financial planning, which is looking at a couple's lifetime assets, their planned spending, doing a financial plan, perhaps doing a few scenarios, comparing that sustainable living standard to what they're actually spending, and answering the question, are you living within your means? If the clients living are above their means, we had to have a conversation about what they could do to make the financial plan work. If they're living below their means, well, you can't take it with you. To spend more money now, think about the other things you could do, retiring sooner, spending more time with your family, these sorts of things. They're very, very useful conversations to have when you root financial planning, I would argue, in a framework which is centered around people's living standards. Okay. So again, to summarize here, right, the lifetime balance sheet is a very useful tool. It lets us figure out a client's sustainable living standard. We compare that sustainable living standard to what they're actually spending and can tell them with a very high degree of confidence whether their financial plan works, whether they're living within their means or not. Okay. So my hope here, I'm distilling a lot of sort of family economics and a lot of financial planning into a few minutes here of a presentation. But my goal here in this presentation here is to illustrate, even at a very high level, how useful of a tool the lifetime balance sheet can be for financial planning, for really sort of planning people's lives in the long run. It neatly summarizes household lifetime assets, expenditures, and help people create a lifetime budget or their sustainable living standard, which is easy to understand. And really, if they are thinking about changes to their lives, what those changes would imply from a standpoint of what they're doing now versus what they could do in the future. And the lifetime balance sheet and this associated concept of the sustainable living standard, they're both really useful tools, I found, and I will argue here, in the context of clients going through divorce, couples going through divorce, because it can help communicate to that couple using real dollars the change in their living standard that would result from divorce, or that would result from several different ways of structuring a divorce. Okay, so instead of focusing on a traditional balance sheet and the mechanics of splitting up a 401k account or selling a house and separating into two homes, doing all of these things, but understanding what it means in the long run to people's living standards, which is what people live on a day-to-day basis in. So with this said, concept of lifetime balance sheet, sustainable living standard, I want to turn to the second session goal here, which is understanding the long-term financial impacts of divorce. And now everybody on this call is aware of the statistics and the fact that divorce is impactful, but I'm going to illustrate that using an approach which I think is novel for most people here. And I'll illustrate using real numbers in just a few slides. So when couples divorce, we necessarily use what I'm going to call the traditional balance sheet, or the balance sheet, to divide the marital estate. And again, perhaps everyone on this call is familiar with this or even works with clients and with their professionals to divide that traditional balance sheet. And here I have the traditional balance sheet here on the left and the lifetime balance sheet here on the right. And I'm going to compare the two. It's going down here. So a traditional balance sheet is a summary of assets and liabilities as of a specific point in time. It's necessarily limited. And if you think back to just 2 slides ago, the illustration of lifetime assets, if you're thinking about current savings, for the vast majority of couples, you are missing out on a huge part of the financial picture. And for most couples, and particularly young couples, and as we'll see, couples in their 50s, you're missing most of the picture. You're missing future earnings. You're missing future Social Security. There's just a lot that is lost when you focus on a snapshot here. Okay, by contrast, a lifetime balance sheet, right, incorporates assets and liabilities over an entire life cycle, from now out to age 100. Okay. The traditional balance sheet, right, leaves out, I'm saying most here, of clients' financial lives. That's true for assets as well as liabilities, but a lifetime balance sheet offers a full picture into a person's finances. Finally, I'm going to argue that a traditional balance sheet exclusive approach, let's call it this, can lead to short-term decision-making, which is sufficient or even required, perhaps for many separation agreements, but can lead to poor long-term, and by poor I really mean expensive, decisions for people going through divorce. By contrast, I think a lifetime balance sheet provides some really valuable insights into decisions which are completely hidden on the traditional balance sheet. Okay. And divorce as a life event is really impactful, and it's the type of situation where I think, in a perfect world, we would apply some analysis. We would take some time to really think about the long-term implications of that event, and how or why is a divorce important? How does it differ from other sorts of risks? Well, divorce really is a special type of risk. It's a special category of risks with major implications for a person's financial future. Again, we're all familiar with some of the statistics, but I'm going to run through some of these things and illustrate it with numbers. Okay. So first of all, divorce is unanticipated. So the idea that nobody goes into marriage expecting to get divorced. Perhaps their friends and family expect such, but for the most part, nobody really goes into marriage expecting to get divorced. And fine, many risks are unanticipated, but divorce is a risk that is also extremely underestimated. Right? Some 50% of marriages will end in divorce. We're all familiar with that statistic, I believe. Yes, the number depends on the population you're describing, but let's call it 50% just to take a simple number. It is the most obvious risks to a married couple's financial plan, but speaking as a financial planner here, it's almost never addressed before the fact. We spend a lot of time in my profession talking to young clients, let's say, about the importance of human capital. That's your future earnings. And therefore, you need a lot of life insurance and disability insurance when you're a young professional. As you're getting older, the importance of those future earnings becomes less important relative to other sorts of things. And we focus on things like not living a short life, but living a long life. Perhaps long-term care insurance becomes increasingly important. As you save more in assets, well, there's more that would be at risk were you sued, were you personally liable? So the importance of umbrella insurance and personal liability insurance. But all of these things are relatively small. The likelihood of dying prematurely is on the order of 1% to 2%, or becoming permanently disabled, about the same. The probability of getting divorced is 50%, and it can have a greater financial impact. It's unbelievable to me that we don't talk about it. The second point I'd make about divorce is that there's no insurance. There's no divorce insurance. So you can't transfer the risk onto a third party. You can try to mitigate the risk. You can try to anticipate it, although it's unanticipated, so it's difficult, but there is no divorce insurance. Interestingly, if after this webinar you have some time, or if right now you'd like to Google, because I can't see you anyway, you can Google a product called Wedlock, W-E-D-L-O-C-K. I came across this in my studies, which is a fellow who tried to package and sell divorce insurance. Sounds like a great idea in my sort of lofty conversation about divorce insurance, but it didn't last more than a few years. And I think you can imagine what it must have been like having conversations with a young, bright-eyed couple and trying to explain to them the importance of divorce insurance, because as you know, 50% of marriages end in divorce. It didn't last very long, and one of these days I want to sort of ask them about what that experience was like. But at least to my knowledge, there is no divorce insurance. There's no way to transfer this risk onto a third party. And really importantly, for the next the next few minutes here, I want to talk about how divorce affects all three elements of the lifetime balance sheet. Okay. So for most people, divorce will lead to a lower living standard. So again, we have a hypothetical lifetime balance sheet here, lifetime assets, committed spending, and living standard support. Okay. Lifetime assets. They may increase, and for some high earners, they will, but more likely, lifetime assets will decrease. The operative factor here is the earnings differential between spouses. So if one spouse is earning a lot, the other spouse is earning no taxable income, let's say, perhaps they're working in the home or they have a lower paying job, that second spouse, the lower earning spouse, is likely to experience a large decrease in their lifetime assets. Okay. Even though, by the way, the stay-at-home spouse in this example provides a really valuable tax-free service, he or she does not pay into Social Security, therefore they have lower lifetime assets if they're divorced and they're relying on Social Security. And if the decision in the past was for that person to leave the workforce, means if he or she post-divorce, it's going to take more time to establish themselves in a career, and it'll likely always be at a lower level of earnings. Think about committed expenditures for a second here, right? So, well, lifetime committed spending is also likely to increase on a per person basis due to things like higher taxes and losses of economies of scale. The talk I gave at the NADP was really focusing on the idea of housing here. And of course, you can take the house as an example. And instinctively, people know that a 2-bedroom house twice as expensive as a 1-bedroom, all else equal, similar house. When two people share, they share one refrigerator and one oven, one kitchen, perhaps one bathroom, right? When people decide to cohabit in college or as young people, they're doing so to save on housing. We know this intuitively. When you split the marital home into two, life becomes more expensive for both people in terms of housing on a per person basis. And as a result, if you have the sort of perfect storm of lower lifetime assets, higher lifetime committed spending, well, what's going to happen to your living standard support? Well, it's going to decrease. For most people, their living standard will decrease and may never recover due to these losses of economies of scale, and again, usually lower income for life. So I want to use a case study in this example. I've run a hypothetical financial plan for Henry and Wendy Clark. Okay. And I'm going to use the following assumptions in this very distilled, very simple plan. And we're going to divorce them, and we're going to follow what happens to Wendy in this case, because I'm focusing on the at-risk ex-spouse. Okay. So let's imagine Henry and Wendy, and they are the sort of prototypical graying divorce. Henry's 51, Wendy is 50. They married 2000, 20 years ago, and they have 2 young teenage children. Henry is in technology sales. He earns a high salary, $375,000 a year, and Wendy hasn't worked since the children were born. Worked for taxable work. She's worked a lot, provided a lot of benefit, but nothing that shows up in taxable income, and it does not increase their Social Security record. In terms of what they own a $1.2 million house with a $200,000 mortgage. They own significant financial resources here, $1 million in retirement accounts, savings for college, a little bit in cash and checking. And in terms of future earnings, which we know is important here, well, Henry's planning to retire at 66, and Wendy currently has no plans to return to her previous job as a nurse. This is what their balance sheet looks like today. They're a married couple, they're not yet divorced, so I want to be clear here. Their traditional balance sheet, this is the one that Henry and Wendy can probably most easily put together, or more easily put together, lists their financial assets, bank accounts, retirement savings, 529 savings, fair value of their house, total assets of $2.4 million, and total debt in this case is $207,000 rounded up. Their net worth on paper, the easiest way to calculate their net worth is about $2.2 million. From the perspective of their lifetime balance sheet, these are worlds apart. We say total assets, it's not $2.4 million, it's $8.5 million, right? Yes, they have, I'm going to use my pen tool again here, they have the current savings that they can see, absolutely. But this is small, right? $2.4 million relative to the rest of their financial assets, their lifetime assets. Earnings, even at the age of 51 here, their future earnings, $5.7 million, are much larger than their current savings. This is true for most families. Contributions, their contributions by Henry's employer here, and their Social Security benefits as a couple, about $1.5 million course of their lives. And their lifetime spending is also larger than you might intuit just from looking at that traditional balance sheet or including the mortgage. Well, there's housing expenses. And this is sort of to Laurel's earlier point about housing being the largest asset, but also the largest expenditure. The housing expenses, this is their lifetime housing expenses associated with not only paying off the mortgage, which is 200 of this 1.6 million, but there's an additional 1.4 million, which is just the present value of property taxes, insurance, our estimates for minor maintenance and major maintenance. So a house is expensive. A house is more expensive than most people think. But to put it in context, the sum of their special insurance expenses, these are things, as I said, their health insurance. This is college for the kids is a large chunk of this, but also Medicare premiums are in here, and their lifetime federal and state tax liabilities. Now, the difference between, here I'm going to use my pen again, excuse me, the difference between lifetime assets and lifetime committed expenditures, that wasn't a very good drawing, I apologize, is what's left over for their living standard, right? This is their lifetime sustainable consumption or their living standard support, this $3.3 million that is available just for their living standard. And I put a little number on here, just we're going to return to this in the future, what this translates to in terms of an annual living standard. A per person annual living standard is $46,000. Okay? The way to interpret this is the amount that Wendy spends individually on her living standard. So this is adjusted for economies of scale. You could also say that if Henry were to predecease her and he had purchased enough life insurance, we want to make sure that he had enough life insurance so that she could maintain her living standard, sustainable living standard of $46,000 a year. And again, the living standard is what people are using to pay for things like food, groceries, eating out, clothes, shopping, travel, memberships, right? The way I explain to clients is sometimes if your living standard is $50,000 a year, we're going to be pretty close if you were spending about $4,000 a month on credit cards, right? That's an approximation, but it's pretty close. So Wendy's pre-divorce living standard is $46 per year. Keep that in mind. We're going to come back to it. Now, what happens when they split? What happens when they divorce? Okay. Well, we use professionals in my situation, and probably a lot here on this call here, right? Use a traditional balance sheet to divide the estate equitably. Pre-divorce, this is their balance sheet, as we saw earlier. Post-divorce, we have Henry on the left, Wendy on the right, and this is just one way of doing it. I'm not making a recommendation that this is the way to do it, but a way that they could divorce, just for illustration purposes here. So if they split their bank accounts in half, if Henry essentially gets his retirement account, Wendy her IRA, Henry takes the kids' 529s but promises to pay for college, and Wendy gets a large house and a relatively modest mortgage. In this scenario, Wendy is better off on the balance sheet. She's just taking more assets up front, and to sort of make the divorce work in this example, I'm saying, well, in exchange for less assets, right, Henry is less than her, you'll pay somewhat lower spousal support for $75,000 for 10 years. And of course, with children, I have amounts in here for child support. These are just assumptions I've used here. Now, again, we could argue about what would be a fairer or more equitable divorce, but let's just take this as a divorce, one way of doing this. And at least comparing the bottom line, look pretty close. Things look pretty close. But what looks close or equitable, perhaps, on the traditional balance sheet looks completely unsustainable on the lifetime balance sheet. So let's just focus on Wendy for a little bit here. This is what their lifetime balance sheet looked like when they were married. I don't know if the number is posted here, but you can see this is about $8 million here at the top, about lifetime assets, committed spending, their living standard support. This is as a household. So yes, this is for the two of them. If we were splitting things in half, each of these horizons would be half the size that they are on the left-hand side. But in fact, when you run the financial plan with these numbers, this is what her lifetime looks like. And I'm keeping the same scale, 9 million, to illustrate the actual difference here, right? Not because it's easy to read, it's very difficult to read, but you can see that Wendy's lifetime balance sheet is almost invisible. Right? You have to squint to see what's going on here. And I'll attach numbers in just a second. But in order of magnitude, lifetime assets drop from $8.5 million to $1.5 million. Committed spending, sure, it drops significantly and drops to about $1.2 million. That is a significant increase. She has fewer lifetime committed expenditures than Henry in this case, but as a fraction of her assets, lifetime committed spending is now 75% of her lifetime assets. That compresses her living standard to just less than $400,000. And that $400,000, that has to last her 50 years to cover a lifetime of groceries, clothing, gas for her car, travel. Travel is never going to happen ever again, right, in this scenario, but it's broken, right? Her lifetime balance sheet is essentially broken as a result of the divorce. And it's important to, what's important? It's useful to see how different these approaches lead to differences, perhaps in even how the client perceives fairness, okay? And by the way, whether this is fair or not, the division of assets here, from a legal sense, in another sense, it doesn't matter at all, right? Because her situation is unsustainable. To put in terms of her living standard, which is how we do planning for clients going through divorce or someone looking for help going through divorce and understanding what it means, from the standpoint of her living standard, she was spending, prior to divorce, the equivalent of $46,000 per year on her living standard. Now, post-divorce, her living standard drops to $8,000 per year. Unsustainable. This is her lifetime balance sheet from the previous slide, just with numbers attached to it. And here's that about $400,000, which is available for a living standard, right? Really importantly, I made a further adjustment to this financial plan because it didn't work otherwise, that I forced a downsize in her future, because if she just kept the house forever, she had a negative living standard. It was so bad, she ran out of money in about 8 years. So here, even with the equitable split, the spousal support, the child support, and downsizing, Wendy can't make it work. Okay? So in a really important sense, in this example here, right? This is of adapting to a different lifestyle. This is about adapting to a completely different and perhaps unsustainable lifestyle. It's a completely different living standard. And this is really my second point for today's session, that at least for certain couples here, for many couples, the data bear this out, right? The long-term impact the divorce has on household finances is significant. And I think you miss the significance of the divorce by failing to take into account a person's lifetime balance sheet. So I was talking with Laurel just before this meeting, right? If I could go and sort of work on some policy state levels, it would be really interesting to incorporate an approach into the sort of court-appointed divorce process. But I'm not holding my breath. So I hope this was useful. To summarize, right, we've taken a look at a lifetime balance sheet, how it incorporates households' lifetime assets and lifetime liabilities, and implies a certain living standard that people can use to figure out whether they are living within their means, above their means, or sort of just right. Seen how divorce fundamentally breaks people's financial plans. Not new news, I think, to anybody on this call, but how taking a view from a lifetime balance sheet, you can see the impact of that, again, of that change from married and then post-equitable divorce, what that looks like for a not insignificant number of people post-divorce. And now I want to switch gears a little bit here, and I want to talk about Social Security benefits. And the reason I'm focusing on Social Security is that, one, it's a very large part of the lifetime balance sheet, right? We've seen it as an account for sort of where it shows up, order of magnitude, but also that it because of the way the government has structured the program, it's an asset which can be not divided in a divorce. Of course, you can't divide Social Security benefits, but it can be coordinated among spouses at the very least to help them increase their living standard without any negative effects on ex-spouses. There's no dilemma when it comes to optimizing Social Security benefits. So, Social Security, right, as I mentioned, it's a large asset, and I think it deserves greater attention, should be incorporated, ideally, into divorce and couples plans. Even if it's not, it's the sort of thing that should be discussed leading up to age 60, 62, when people can file. So, give you a sense of the order of magnitude, for an upper middle class taxpayer, Social Security is worth as much as about $1 million today. That number is just a present value calculation. It makes sense this way. If somebody filing for Social Security today at age 70 might be eligible for $3,500 a month in benefit, call that $40,000 a year, again, just to make the math simple. Over the course of 30 years, $1.2 million, 12 million would be nice. $1.2 million discounted to today, that's where we get $1 million. Okay, it's not a made-up number. A divorcee, and be careful about my language here. We're talking about a couple that is split. So the divorcee I will refer to, that's kind of the Wendy in this situation, the stay-at-home spouse or the lower-earning spouse. And the ex-spouse I will describe as the spouse who works Social Security covered earnings. So a divorcee may be eligible for Social Security retirement benefits based on their ex-spouse's record. Very importantly, this benefit does not in any way negatively impact their ex-spouse. Okay, so it's not as if there's an account, a financial account somewhere, and somebody starts taking out of it for the other person. No, the divorcee, an eligible divorcee, is able to apply for benefits, and those benefits in no way negatively impact their ex-spouse. This benefit, the two types of Social Security benefits I'm going to talk about. The benefit could be very large, and it's particularly important where there's an earnings differential. When you have the high earning spouse and the spouse who either stayed at home, raised the children, took care of the house, or earned at a lower level. And again, as I already said, right, Social Security is one of the only assets, and the only asset I can think of that can be split in a divorce without disadvantaging the other party. Okay. So I'm going to talk about two benefits here. Social Security, just very, very briefly, if I can distill the Social Security system into 30 seconds or fewer. To describe Social Security, it's a program made up of 4 categories of benefits. Retirement benefits. These are the benefits I think most of us think about when a taxpayer turns 62. They were eligible to file for Social Security retirement benefits. Disability benefits, Category 2. That same taxpayer, if they become disabled under definitions of Social Security, they can be eligible for an income benefit. Dependent benefits, third category, is a bit of a catch-all, but that's a benefit for a taxpayer's family members under certain special circumstances. And the fourth category is survivor benefits. So a benefit that would help a taxpayer's surviving family members death. The first two benefits are, let's think about those as direct benefits, so the benefits accrue to the taxpayer, his or herself. The second two are auxiliary benefits. So these are benefits that accrue to a taxpayer's eligible family members. And an ex-spouse may qualify as an eligible family member under certain conditions. And there are two types of benefits that eligible spouse may be able to receive. So one is spousal benefits. You might put an X in front of your ex-spousal benefits, but a divorcee could be entitled to spousal benefits if they met these requirements. So the divorcee must be at least age 62. So this is the minimum filing requirement. You cannot file for benefits any sooner than 62. Their ex-spouse must be 62 when he or she files, or be disabled. I don't have time to get into the minutiae of disabled, but that's part of the rule. The marriage requirement is a requirement that the marriage between the two must have lasted at least 10 years, and this is a cliff requirement. This is one of those terrible aspects of the law that if a couple was married for 9 years, 363 days, and they divorced, that divorcee would not be eligible for spousal benefits. It's all or nothing requirement. And the fourth requirement, that the divorcee not be then married when he or she files for spousal benefits. Interestingly enough, if they were married and they subsequently divorced again, they could become re-eligible for spousal benefits. That's important. The second category of benefits a divorcee could be eligible for are survivor benefits. And they have a similar set of requirements, albeit somewhat different. There's the filing requirement, the age requirement. You have to be at least 60 to file for benefits. The marriage requirement, which is the same. The marriage must have lasted at least 10 years. And that the divorcee not be currently married unless he or she remarried after age 60. What is the import of being remarried after age 60? I do not know. You'd have to ask somebody in Congress who was there when they modified the Social Security Act. But so these are the requirements for eligibility for a divorcee to receive either spousal benefits or survivor benefits. And I want to talk a little bit about how the benefit is calculated. And I'm not going to get into deep math here, right, because we're a group mostly of lawyers, but I'm going to run through the requirements, and then I'm going to illustrate from a lifetime perspective what these benefits mean, okay? So there's no reason to memorize this. The benefits are really a function primarily of two factors. So one is how the benefit is calculated, regardless of a filing age here. So let's think about this for a moment. What I'm going to call unreduced benefit amount at full retirement age, because it's reduced if you take it beforehand. But the unreduced formula is this. For spousal benefits, a divorcee could be eligible for 1/2 of their ex-spouse's primary insurance amount. Primary insurance amount is just a technical term for saying somebody's retirement benefit at their full retirement age, essentially at age 67 today. So if you took a very simple example, couple divorces, the working spouse has a PIA of $3,000, primary insurance amount of $3,000. If their ex-spouse never worked, they would be eligible for 1/2 of that person's PIA, or $3,000 divided by 2, $1,500 a month. Okay. This little part over here, minus the beneficiary's PIA, this covers the situation where the stay-at-home spouse or the lower-earning spouse earn themselves. This reduces spousal benefits, but importantly, because the spousal benefit adds on, the person's still better off. So just take a very simple example. That same person worked a little bit. Their retirement benefit is now $500 as well. The spousal benefit is $1,500. 3,000 divided by 2 minus 500, which is now $1,000. But they receive their own retirement benefit as well. So they're getting $1,500 a month in benefits. Okay, so an important part about spousal benefits here is that it's an add-on benefit. It can add on to somebody's existing retirement benefit if they have one. The survivor's benefit calculation is a bit easier. The survivor just steps into the shoes of the deceased taxpayer here. So if the taxpayer was receiving some sort of benefit, maybe their benefit was $2,000 a month. They pass away, an eligible surviving spouse or ex-surviving spouse would receive that $2,000 a month for life. Perhaps their benefit was $3,500 per month. An eligible ex-spouse could receive $3,500 a month for the rest of his or her life. Okay, but an important distinction here: a survivor benefit, it's an either or. When you are alive, you're receiving your retirement benefit plus the spousal add-on, if applicable. Upon the death of an ex-spouse, you can receive the higher of your own benefit or a survivor's benefit. They are not additive. So the survivor's benefit and spousal do not add together. Okay. A point about filing, and I'm going to make a point about this really in the next slide here, is that filing matters. People can apply for benefits as early as 62 for spousal benefits. If they do so, that benefit will be reduced by 25% for life. Okay, so you could file early, take a lower benefit, or you could wait until 67 and receive your full benefit. There's no benefit of waiting past 67. Something similar is true here with survivor benefits, which you could file as early as 60, recall. If you do so, you'll receive a 30% reduction for life. If you wait until your full retirement age, you'll receive the full benefit, right, or your ex-spouse's retirement benefit. Now, a lot of numbers there, a lot of math, a lot of ifs and ors, and this is Social Security, unfortunately. I want to return to a simple example, or previous example, Wendy and Henry, and I want to illustrate using real numbers here what all of this means in the context of somebody's lifetime finances. So the next slide, I'm going to talk about spousal benefits, and then I'm going to talk about survivor benefits. In terms of dollars and cents, what does this mean for over somebody's life? Okay. All right, so Wendy's spousal benefit. Her spousal benefit can vary, and it will vary primarily based on when she files. So let's just review some of the numbers here. Henry's primary insurance amount, this is his retirement benefit, 67 is $2,500. Wendy has her own PIA because she worked for a few years nursing, so she has $500 a month there. This is important. If they divorced, again, 9 years and 363 days, Wendy would only get this $500 per month. But if they divorced after 10 years, she would be eligible for the spousals. That's a really important point. So if you are working with divorcing clients and you see this, somebody close to 10 years, it's important to point out. Time for a very short story here. I have a dear friend. She is a zookeeper, and her husband is a software engineer, and they have a 6-year-old son. And they've been together for 24 years, only married for 9. They separated a couple years ago, but we really had a long and hard conversation about postponing the legal divorce, if possible, to reach the 10-year mark, because from her perspective, she has much lower earnings than he does, and it protects her if he predeceases her. But importantly, from his perspective, he has a son with her, and if he's worried about his son seeing his mother in old age run out of money, then one thing that you can do for each other without hurting the other person is to coordinate to the extent possible on Social Security. So there's just a side story there. Back to the numbers here for a moment. So So Henry's PIA, Wendy's, her unreduced spousal benefit, really easy to figure out. It's just half of Henry's minus her own. So at age 67, just by virtue of having been married to Henry, she's able to receive an additional $750 per month in retirement benefits. So her $500 that she has on her own plus $750, that's $1,250. Now, Wendy might choose to take this benefit early. She could take it as early as 62, and if she does, that benefit will be reduced by 25%, and her spousal benefit is now $525, which of course adds on to her retirement. The difference between those two, this is just in terms of filing now. If she files at age 62 versus filing at age 67, is the difference over her life of about $366,000 versus $432,000. That's a difference of 20%. Okay, so this is a difference of 20% in a zero-rate world where checking and savings is paying a negative real rate, and just by waiting longer, she can increase on her lifetime balance sheet her lifetime assets by 25%, by 20%. That I think is hugely important, and especially for someone like Wendy, who we saw experiences of large difference in her living standard. This is one of these things that, as lawyers, you do not have to be calculating. You should not be doing the financial analysis and things like that. But it's an issue that I think you can spot, and you can be prepared to identify and say, this is something you should consider thinking about. This is something you might consider hiring a financial planner or an accountant to help you understand, because there is a significant potential benefit there, and you want to be aware of it. And if you can help your clients figure that out, you may have just paid for the divorce and then some, and that's a nice thing to do. Now, these are the numbers for spousal benefits, which is interesting. And I'm going to end by talking about survivor benefits, which are potentially much larger, but there's a lot more variability and there's a lot more things out of people's control. So remember, survivor benefit is a benefit that you're eligible for when a spouse, or in our case, an ex-spouse, passes away. And you step into the shoes of your spouse or ex-spouse and assume their benefit if it's higher than your current. So Wendy becomes eligible for survivor's benefit when Henry dies. That's the nature of a survivor benefit. How much she receives over her lifetime depends on three factors, and I'm really just going to focus on these first two. So one, again, when she files matters. If she files for benefits early, she can file as early as 60. She'll receive a 30% decrease, lifetime decrease in her benefit, and that affects the math, and we'll look at that. Very importantly, unlike for spousal benefits, which are based on a PIA, which has nothing to do with what your ex-spouse does, the survivor benefit is based on your ex's actual retirement benefit. And Henry, there's a lot of possibilities here. Henry has a retirement benefit, and he could have filed early. In fact, he could file as early as 62, and this number right here, this $1,750 per month, that is the reduction that he would receive in his PIA if he filed at 62. And remember, Wendy just received that amount. So if Henry files early, and if Wendy files at 60 in pink or 67 in green, her lifetime benefit could be $612,000 or $712,000. She is $100,000 wealthier simply by delaying Social Security. I'm not aware of any other asset that's available where both people are just as well off, and all we're talking about here is sort of some planning. If we can counsel Wendy to get her to age 67, if we can help in the divorce process to make sure she hasn't her to that point, she could be potentially a lot wealthier. Finally, if Henry had been a conservative fellow and he didn't file until age 70 and he passes away before Wendy, well, now her benefit is about $1 million. Again, that's Again, she just steps into his shoes. There's $1 million on her lifetime balance sheet. Imagine how that changes her financial plan. But Wendy, of course, has no control over, one, when Henry files for benefits, right? She can't force him to wait. And certainly she has no control over his lifespan, or at least we hope ex-spouses don't have control over each other's lifespans. So the takeaway here, right? So, if you think about how much Social Security can matter to clients' finances, it's a lot. It's potentially their biggest asset, depending on the circumstances. So, I argue that helping clients understand this asset, putting them in a position to be able to afford delaying benefits, these are value adds we should all think about incorporating into our practices. And I hope I made these points clear. I know we've covered a lot of ground in this presentation. So just to summarize, right? A couple's balance sheet is more than current assets and liabilities. In fact, it's much more, right? By order of magnitude. The lifetime balance sheet shows the impact of divorce on a person's living standard, their sustainable living standard, and that can be very significant. Social Security, with a large potential assets, about $1 million for medium to high earners. Eligible divorced spouses can receive one of two benefits, spousal or survivor benefits. Spousal is easier to understand, but the benefit is potentially smaller. Survivor benefits are potentially much larger, but people have less control over what that amount may be. Professionals, perhaps like people on this call, should think about, certainly when they're drafting separation agreements, steps that you can take to help clients maximize a potential lifetime Social Security benefit. If that means more cash, running some financial projections that gets them to age 67 so that they can afford to wait, I argue that's probably in most clients' best interest and something we should be thinking about. And this is one point which doesn't apply to all divorces, but in the ideal world, ex-spouses may mutually benefit working together on a Social Security filing strategy. I think about my friend and her husband delaying divorce until 10 years. If that husband waits until 70, he's also protecting his ex-spouse, which is in a sense protecting his son. So there are things that people can work together on. We can split a pie, and we can still get half of the pie, versus nearly every other asset in divorce, we split the pie in half and people get less than half. This is one of those things that I think people can come to agreement on, potentially, and therefore something that we should all be aware of. And with that, thank you very much. I know there was a lot of information and a lot of numbers for lawyers on the call, but I sincerely hope this was helpful.
Yes, indeed, Frank. Thank you so much. This was, I think this was very eye-opening. We do have several questions that I would like to go ahead and ask you. A couple of my own takeaways. It is cheaper to keep her or him. And secondly, it is up to the millennials and Gen Z to keep Social Security alive, because that is the parachute, it sounds to me like, for a lot of people to stay afloat. So a couple questions that we have here. So Laura McGee, she has asked if wife is in CalSTRS, so that is for California, like teachers pension or California pensions, and therefore not eligible for Social Security, but then divorces. Is she now eligible for divorced spouse Social Security?
It's a very good question. And this boils down to Social Security is extremely complicated. So benefits that can accrue to people who did not have Social Security covered work, you're talking about two rules that come in here. There's the WEP and the spousal offset, GPO. This is impossible to do in one's head because it depends on the quantum of the benefit. It depends on timing. You really need a financial calculator. We've worked with an economist, Larry Summers, that was my president in college, Larry Kotlikov, for years. He's over at BU, and his software is Maximize My Security. You can use that with the information, and it will help people see to what extent Social Security will sort of fill in the gaps, if any, with state pensions. It's difficult, but there's no way to tell by using.
That was called again, Maximize.
Maximize My Social Security. Yeah, Larry Kotlikov. He's
Okay.
The real bigwig in the Social Security world.
Steve, and I think you're Steve Levine, right? How does Social Security handle additional ex-spouses for surviving benefits?
There are some very interesting kind of fact patterns. You can imagine someone who was married to 4 different people for 10 years and a day each, and those ex-benefits carry over. So if you were being very, very strategic about this, you could marry people of different ages for exactly 10 years and a day and do this, but so long as you are not married when you file for your benefit, then you are eligible for potentially many, many different types of, let's call them ex-spousal or ex-survivor benefits.
Interesting. Tina Chen. Hi, Tina. So her question, and then she put a qualifying as well. So her question is, does the ex-spouse survivor benefit automatically kick in upon death of the ex-spouse, or does the surviving ex-spouse need to apply for Social Security? She clarifies that, saying that this is assuming that the surviving spouse is already receiving Social Security benefits. Just wondering if the ex-spouse needs to monitor the obituaries, or if they have no contact with the ex-spouse to avail themselves of this benefit.
That's a very good question. I'm going to do my best here, but I'm also going to qualify by this saying I'm not quite sure. There's a great topic on this. Ask Larry. This Larry Kotlikoff thing is these sorts of questions. Mm-hmm. I know, for example, that you have no way of knowing if your ex-spouse is filed for Social Security. The SSA has said that's an element of privacy, which we're going to protect other people from knowing. Now, it's my understanding that the SSA keeps track of marriages and also keeps track of divorce records, right? Because when somebody dies, it goes to the SSA and they stop benefits. That should trigger any sort of auxiliary benefits, and those beneficiaries should be getting those benefits automatically. But I would have to look up the minutiae on that. I've never happened to have had it happen to my own clients, but that's a tough one.
Interesting. The stuff you see, right? Excellent. Okay. So Steve, thank you for the tip there that is in the chat. And then Pamela Edwards Swift, she has got a question. As a practice point, is it better to argue for Wendy a larger portion of the assets, or argue for more spousal support?
Yeah. So it's going to depend, right? Because spousal support now is taxable to the payor. And you might say, well, in the long run, you could structure this in such a way so as to get sort of things that are better off for both people, which I think is more likely to pass muster in a settlement agreement. But fundamentally, I think it's sort of whatever gets her to, my fact pattern here, age 67, whether that's savings, whether it's you could take a HELOC perhaps against the house. There's lots of ways you could do it to get her that extra money, and sort of after all costs are taken into account, she's still better off. Mm-hmm. So it's really, I think, fact pattern dependent.
Gotcha. Okay. Excellent. Well, we are just about out of time. If anyone has one last question, we might have time for one more question. But other than that, again, the real estate aspect of the case, the amount of money that is available in equity for the property, the amount of expense that when mishandled, and I mean even when a property is remains on the market for too long due to sales sabotage, days on market for real property depreciates the value of the property. So when you've got a client with sales who's committing sales sabotage, they are actually depreciating the value of the property. So, it's again, your point drives home, Frank, the importance of maximizing the value of the property, ensuring that that the financial aspect of the real estate is taken care of. As soon as somebody starts missing mortgage payments, as soon as properties go into foreclosure, God forbid foreclose, everything you just said about the lifetime balance sheet gets even worse and even more dismal. And so it is,
Laurel, I think about the capital gain of that house. You don't see it.
Yeah.
But she will be paying it if she has to sell the house, if she finds out you can't afford it, right? Those are the types of things that you miss, right? You miss without sort of a
you absolutely miss it, and I had that case. I had the case where the wife got the investment condo. The capital gain was not taken into consideration. It was post judgment, post decree. And, you know, a year later, she has to sell it, and it cost her $60,000 in capital gain that no one caught during the divorce. So again, shameless plug. This is what CDREs are here for. This is what CDREs are educated to do to help you in your cases, because we believe that divorcing homeowners deserve to have an expert handling the real estate portion of the case, just like they're experts in every other aspect of it. So thank you again very, very much, Frank. Again, eye-opening. I appreciate your perspective, and I think everyone got a very good lesson today. And please stay tuned for our next one, arethebar.com, and it is about emojis as evidence in domestic violence and custody. So, all right, thank you all, and have a great rest of your day.